Netflix just reported their latest earnings numbers, and despite a triple beat, meaning beating estimates on top and bottom lines, and also with regards to the net addition for subscribers, the stock is down. The stock at the time of making this video is down 3.2%. Now, right now, Netflix, if you look at the valuation, forward PE, EV to EBITDA, price to sales, price to free cash flow, it is cheaper than its 5-year mean. If you look at price earnings to growth, it sits at 1.18, which in my opinion is quite cheap. Has a market cap of $264 billion. Now, year to date, the stock is up 25.5%. On a year-over-year basis, the stock is up 83%. Despite all that, I still think that with regards to valuation, it is not that expensive. Why is that? Well, if you look at the analyst expectations for the fiscal year 25 and fiscal year 2026, you're paying around 25, 27 times these estimates, which in my opinion, for a company that can grow its bottom line over 20% year over year, I think that's quite attractive. Now you might be asking, okay, fine, that's great, but why exactly is the stock down after such a triple beat? Well, if you're just interested in that, I'll give you the answer right now. So they say here, as we've noted in previous letters, we're focused on revenue and operating margin as our primary financial metrics and engagement, i.e. time spent, as our best proxy for customer satisfaction. Now we're generating very substantial profit and free cash flow. In addition, as we've evolved our pricing and plans from a single to multiple tiers with different price points depending on the country, each incremental paid membership has a very different business impact. It's why we stopped providing quarterly paid memberships guidance in 2023, and starting next year with our Q1 2025 earnings, we will stop reporting quarterly membership numbers and average revenue per membership. The market clearly did not like that. So there you have it. That's the main reason. If you want more information, stick around. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, really appreciate that. We're going to cover many companies in the next following weeks, so make sure you're subscribed to this channel. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So they're off to a good start in 2024 compared to Q1 2023. Revenue is up 15%, our operating income grew by 54%, and our operating margin rose by 7 percentage points to 28%. For fiscal year 2024, they forecast revenue growth of 13 to 15%. They're raising their full year 2024 operating margin forecast to 25% based on FX rate as of January 2024. It's up from 24%. And so if we look at the most important points here, operating income came in at $2.63 billion, operating margin 28.1%, net income $2.33 billion, diluted earnings per share 5.28. With regards to global streaming paid memberships that increased 16% year over year, they added 9.33 million new subscribers. Net cash provided by operating activities, $2.21 billion. Free cash flow, $2.13 billion. Shares outstanding have been reduced again quarter over quarter. They say here, as they noted in the last letter, the two priorities in ads are to scale the member base and to build out the capabilities for advertisers. They made progress in both fronts in Q1. Their ad memberships grew 65% quarter on quarter, after rising nearly 70% sequentially in each of Q3's 2023 and Q3 of 2023, with over 40% of all signups in the ads market coming from the ads plan. For advertisers, they continue to focus on measurement solutions, including new partnerships with Kantar and Lucid for brand awareness and recall, and Nielsen Catalina solutions for sales lift, and they're working to build out their sales capabilities. With regards to the forecast, for Q2, they forecast revenue growth of 16%. This equates to 21% growth on an FX neutral basis. They expect paid net additions to be lower in Q2 versus Q1 2024 due to typical seasonality. They forecast global ARM to be up year over year on an FX neutral basis in Q2. Their goal is to increase operational margin each year, though the rate of expansion may vary year on year. With regards to Netflix's reach, so almost 270 million households across over 190 countries now subscribe to Netflix. With more than 2 people per household, on average, they have an audience of over 500 million people. No entertainment company has ever programmed at this scale with this ambition before. To satisfy such a large audience, we need many great stories that appeal to lots of different tastes. And by great, we mean movies, series, and games our members love, i.e., we take an audience-centric approach to quality. Today, their share of TV viewing is less than 10% in every country. So they still have plenty of room to add value for the members and grow their share of viewing by broadening their slate, including with live events, comedy, sports, competition shows, music. Of course, they've announced the partnership with the WWE, the boxing match between Jake Paul and Mike Tyson, which I still cannot believe this is actually happening. Plus, we've had the live events with regards to Rafael Nadal, Carlos Alcaraz. There was also the golf thing with regards to the guys from Full Swing and the guys from F1. So they're trying out new things, and I do think that live stuff is going to be very, very successful for Netflix. They say here that so far this year they've had the #1 streaming movie for 8 of the first 11 weeks and the #1 original series for 9 of the first 11 weeks, according to Nielsen's. And just so you know, this is basically their share of US TV viewing for streaming only. In the last month of the quarter, it has ticked up. Overall, it is higher right now in the last 3 months than in the last, let's say, 4 or 5 months of 2023. Then some more impressive numbers with regards to the product and marketing. So their most direct promotional tool is Netflix itself, which has become the go-to place for so many people looking for entertainment. Our trailers, for example, generate over 6 billion impressions every month on Netflix. That's more than 40 times what they get on YouTube. It's pretty impressive when you think of it. Plus, we know that Netflix has a huge following online as well. If there is a hit show, it is probably going to be one that is on Netflix. Doesn't always necessarily needs to be produced by Netflix, but it usually reaches the mass market thanks to that platform. Last couple of things here, net cash generated by operating activities, as we've seen, was $2.2 billion and free cash flow $2.1 billion, both flat with Q1 2023. During the quarter, they paid down $400 million of senior notes with cash on hand, and they repurchased 3.6 million shares for $2 billion. And last thing here, over the past several years, we have maintained a consistent capital allocation strategy that we believe has served us well. 1. Fully fund our business and new initiatives. 2. Maintain strong liquidity and a healthy balance sheet, $10 to $15 billion of gross debt and cash balances equal to approximately 2 months of revenue. 3. Pursue selective M&As to complement our organic growth investments. And 4. Return excess capital to shareholders through stock repurchases. And so right now, if we look at the stock under $590, meaning the stock is under the 50-day moving average right now, which is going to be very, very interesting if it can finish the week maybe above it. If not, then the 200-day one sits very close to $500 at $497. Of course, in the last couple of weeks, the stock was overbought. So hey, maybe around $500 or so could be quite a nice opportunity if you already have a position you want to add, or if you were always looking to buy this company but you always wanted it a bit cheaper. 200-day moving average could always be an opportunity. So that will be it for this video. Triple beat. Yes, the stock is down. In my opinion, it's an opportunity to buy the dip. You don't have to directly buy it. Usually it takes a couple of days for the market to actually react accordingly. So as always, take your time, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.